Welcome everybody for coming. I'm Scott Bogus. I'm a new faculty member here at the University of Texas. I'm directing a program in securities markets regulation that is housed in the Center for Enterprise and Policy Analytics. And we are starting a new speaker series on financial market regulation. And the intent is to help bring how real world decisions are affected by government policies in areas and industries and professions that all of you are seeking to gain employment or otherwise doing research in. So thank you for coming. We have today Andrew, AKA Buddy Donohue, and he was here yesterday for a Regulation BI conference. He gave the keynote talk, and he agreed to stay over and do an interview with me. He is a very accomplished person. He knows more about asset management than I can ever hope to. He has twice been in government. He was the director of the Division of Investment Management at the Securities and Exchange Commission under Chairman Christopher Cox and then Mary Shapiro. He left to go to Goldman Sachs, where he was investment company general counsel, decided to come back and serve as chairman or chair Mary Jo White's chief of staff. He's also held top jobs at Merrill Lynch and Oppenheimer Funds and at various law firms, and probably too many that I don't know about. I want to welcome him here today.
Different way of saying I had trouble keeping a job, I guess. But that's...
And so I want to ask him about questions about the changing landscape of the asset management industry. And before we get into some of those questions, I want to probe a little bit on your past and how you got here. And the first thing we need an answer to is, you're a lawyer. Can you explain that?
I can, and when I tell my law students this, they are aghast. I went to law school by mistake. I was an economics major in college, and so I graduated with high honors in economics. And I got married in college, and my son was born my freshman year of law school. But one of my friends in college is actually a better friend of one of my good friends. The three of us had gone to high school together. We're all in the same college. And one of them, Tom, wanted to go to law school. So my other friend, Nick, comes up to me and says, "Hey, buddy, Tom wants to go to law school. You want to go take the exam with him?" I said, "Nick, what's the exam?" He goes, "I don't know. It's LSATs or something like that." I said, "Well, what is it?" He says, "Don't worry about it. I understand it's a logic test. We'll just go take it." So fine. So I signed up. I had no idea what an LSAT test was. So we went and took the test. As a matter of fact, we were out partying. By the way, back then in New York, you could drink when you're 18. So, we were out partying the night before, and because that was a Friday night, and then Saturday went and took the test. And results came back, and my friend Tom that wanted to go to law school didn't do that well. So it was going to take him a while to get to law school. Nick was and still is really a genius. So he was probably at the top 0.5% of the people that took the exam nationwide. So Nick could go wherever he wanted to go. And I did quite well. And so my wife said to me, "So what are you going to do? You love economics." And I said, "Well, I'll tell you what, next step, I'll apply to law school. If I get into good law school, I'll go to law school." I guess it's telling me something. And so I applied, and the only school I didn't get into was Columbia Law. I was waitlisted, but I got into NYU Law. I found out later a lot of my colleagues at NYU had been waitlisted at NYU and gotten into Columbia. But in any event, so I wound up going to NYU.
So Columbia knew better to admit you.
What?
Columbia knew better than to admit
Columbia, the problem with Columbia Law School back then was that a law professor actually been killed up there. It wasn't the safest environment. NYU was actually located down in the Village in New York. And so I'm going to law school. And I lived on Long Island, so I used to take the Long Island Railroad in every day to go to law school, and then take the earliest class I could, and then take the railroad home, and then go out and after my freshman year, go work. And so I was competing against people who just were going to law school and whatever, but no regrets. But that's how I went up in law school. So it was.
So you became a lawyer. You held jobs at various levels until one day you ascended to be a general counsel. And can you just tell us what it means to be a general counsel?
Actually, I'll tell you what my first job was at law school. I was hired by a very small firm that was privately owned on Wall Street, right? And so it had a retail brokerage firm, it had a discount brokerage firm, it had an advisory part of it. It owned a life insurance company, and it had mutual funds. And I was their first lawyer. Right? So I went to this stuff. By the way, I took no securities law courses in law school. I couldn't spell securities. And I went in and from day one worked for the chairman. And, he, basically was very supportive of me taking on as much as I could take on. And so through the years, wound up, I created a commodity trading advisor for the firm. I bought a bank for the firm. As I learned things, I wound up progressing. And in 14 years, when I left, I was president of all the mutual funds. I was on the boards. I was one of the top executives. I was probably one of the top 3 executives for the whole firm. I chaired their investment committee. I was general counsel of the firm. I had all legal compliance, a bunch of other responsibilities there. And we were vertically integrated, so we did everything for the funds but custody. But I learned an enormous amount from them. So I learned a lot about the markets. I had an old-time trader that had an office around the corner from me. So I'd read a rule and say, this made absolutely no sense to me. So I go to him and say, hey, Vic, why is this rule? He goes, oh, buddy, before that rule, here's what happened. I said, whoa, that's not good. And he goes, no, the rule stopped that. I said, okay, I understand the rule now, right? And so, really, really helped along by a lot of folks. Just had a great opportunity when somebody took a risk on me. And, I did that. I wound up leaving.
You really were a general counsel.
Yeah.
You generally counseled on many things.
Well, not only, it was a small firm, so I did all the legal work on everything. So you needed to know everything. And it was an easier time. And so you have more time to do things. And you had the capability, really, of, spending a little time on things. And
you didn't have a smartphone back then?
No. I mean, you didn't have
email.
computers back then. You had mainframes back then, but that was about it.
Took your punch cards over there to get your answers?
Yeah.
So now you're an independent director for BNY Mellon Funds.
I am.
So what does that mean? Like, what do you do? You show up 12 times a year and say, good job, and collect a paycheck?
Well, if you ever want to understand the responsibilities of mutual fund directors, among other things I've done in my life and I'm doing in my life, I'm co-editor of the American Bar Association's Director's Guide to Fund Directors, in terms of what all their responsibilities are. The whole range of responsibilities that the regulatory regime for investment companies put upon boards, right? So there's a lot of the requirements are driven by regulations, but there's a number that are driven also by the statute itself. And by the way, I mean, you basically are a director, right? So you have state law responsibilities in terms of being a director of the entity, and you want to make sure that things are being done well. But mutual funds themselves don't have employees, right? It's an entity that basically hires a whole range of service providers. If you're a director, one of the things you need to do with regard to every one of those service providers is to make sure that the quality is there, right? That the arrangement that you have is appropriate, that they're doing their jobs well, right? And that's extraordinarily important to do with. Most people think that all you do is going to look at what stocks the fund bought and sold over. And there's an aspect to that, but you don't micromanage that, but you do like to know what's the performance been, what strategy is being followed, what are the risks that are being taken. And you look at things really from the perspective of the shareholders of the fund. You're there really as the guardians for the shareholders of the fund and make sure things are being done appropriately. The normal, we meet 5 times a year, and the meetings can go anywhere from a day to a day and a half. But the materials that you get in preparation for the meeting are 1,000 pages, right? And so they're, obviously we don't get them in paper form. But
and this is why you teach at Brooklyn Law Schools. You hire a couple of students to read them for you and write the Cliff Note version.
That'd be interesting, except that you can't even download and print those documents. You have to review them online and stuff. But I love doing it. So before Bank of New York Mellon, I did it at Oppenheimer. And just I just love the industry. I love the business. And it's a really, from my perspective, very important role. I also sit on a mutual fund directors forum, which is a nonprofit organization that is for independent directors.
So let's go to 2006. That is the year you decided to go into public service and become the division director for investment management at the Securities Exchange Commission. Can you just explain why you did that? Yeah.
Once again, I had a fabulous job. I was the global general counsel for Merrill Lynch Investment Managers. So we had used operations around the world in terms of investing money and stuff. And so I was the global general counsel and loved my job. It was just fabulous. Merrill Lynch, the parent company, made the determination they wanted to sell Merrill Lynch Investment Managers to BlackRock. And so I was part of the very small team. You can imagine how well this was kept under the wrap. You had two public companies engaged in this. And so that negotiated that arrangement, the final deal. And I realized that I was not going to be general counsel of BlackRock. And despite everything that Merrill Lynch could do to get me to want to do that and how much BlackRock could want me to do, by the way, the deal, when it closed, Merrill Lynch owned 40% of BlackRock, right? So they had a real interest in making sure this worked, right? And BlackRock really wanted to have somebody make sure that the people who knew how Merrill Lynch investment managers worked because we were much bigger than BlackRock was, right? And so I had folks who wanted me to be there, but for different reasons. In any event, I knew that there was an opening down at the SEC, so I went to my wife and said, I'm really interested in putting my name up. So if you want to go ahead and do it.
You know there's an opening at the SEC, like the top job in investment management, just open, they have a sign on the door that says...
No, it was Paul Roy had left, and Susan Wydurko was acting, and they had not filled it. And so I put my name in, and by the way, I did not know Chris Cox.
Oh.
And I wound up...
So you arrived.
Fortunately...
You had a year.
He said, sure. And just what I find an interesting story was that the fund board approvals of the BlackRock deal, because it's an assignment of the advisory contracts, so every fund board had to approve it, and then it had to go out to all the fund shareholders. So one of my jobs before I left was to get the fund boards, and there were 4 cluster boards of Merrill Lynch at that point. So I had to get all those approvals. Those approvals all took place on Monday, Tuesday, Wednesday, and Friday, right, before I left. And Chris Cox was adamant that I had to start on Monday. So the time between my 2 jobs was the weekend. And I had no place to live in D.C. I was, my wife and I had gone down the Friday before, and we finally located a place. And, but I lived in New Jersey. I worked in New York. I didn't have a place to live in. So, I wound up starting on that Monday and wound up getting, sworn in that Monday.
So you show up in 2006.
By the way, I never worked at the SEC before. Right, so part of the joke at Merrill Lynch was I took the job thinking it actually was the Southeast Conference, and basketball tickets were available and football tickets and whatever. But
so when you took the job, did you know the financial crisis was coming?
No, nope. On the other hand, I will tell you that if you're a general counsel inside firms or you're at a regulator, you're always anticipating the worst. It's not that you want it.
It's just in your nature.
It's your nature because you are the worrier. Like it's okay. What do we do if? Right, and that's kind of like the way that I always have my career. By the way, well, you're all too young, but the market event in 1987, sometimes referred to as the crash, I was president of a whole mutual fund family that time. So kind of lived through that, and so I've always had an appreciation for the resiliency of markets.
So can you tell us what it was like? You had 2 years practice at the SEC. You learned how to...
That was fun.
Push all the controls, knew how to make things happen.
Yep.
And summer of 2007, things start getting a little shaky in some of the markets, and it just kind of slowly goes downhill until all hell breaks loose. Can you tell people what it was like to be at the SEC during that time?
Very, very interesting. Most of my career had been in the industry. So when things started happening, I had a sense, I think better than my colleagues or the folks that worked in my division, of what the implications were for some of what was going on. And part of the, one of the first things that happened that was noticeable, if you would, was when Bear Stearns ran into trouble. And when that was occurring, you wound up with, at least from my perspective, J.P. Morgan being strong-armed in March to, in effect, take over Bear Stearns. And if you run a division, nobody just walks in. If you're J.P. Morgan and want to buy something, by the way, the day you close, which was going to be tomorrow, you've already have violated a whole range of laws that are administered by the investment management division, right? Why? Well, funds that, financial products that were run by, by Bear Stearns actually invested a lot in J.P. Morgan things, right? So it's not like that they own J.P. Morgan debt, or that they all affiliated kind of things that they're not allowed to do, derivative contracts, but they, and so we wound up having to negotiate really the no action position that we would take.
What does that mean, no action?
No action means that as a division, we're not going to recommend enforcement take action against the recipient, if you would, of a no action letter. It doesn't change the law. So it doesn't mean that you complied with the law on something, but rather that we're not going to send it to enforcement. And it's a very effective tool for a variety of things where you don't have time to really do exemptive, but you want to help facilitate something that needed to happen. Just a funny story about Bear Stearns. So I was at the Mutual Funds Conference in March, right? And we were in, I forget whether it was in Arizona or whether it was in California, Palm Desert. But I was out playing golf on Sunday morning, and my phone starts ringing, right? And my best friend was playing golf with me, and his phone starts ringing. Well, he was counsel to Bear Stearns funds. And I'm getting calls from my people back in Washington, buddy, we need to talk to you about that. And so for the first 9 holes, we were, separated, talking on the phone about what, and so obviously we quit after 9. And then that whole day was just basically working through what we could do to help facilitate the J.P. Morgan takeover, really, of Bear Stearns. And that, delayed the real issues in the marketplace, but it also told you that there was a lot of frailty. That the markets were frail at that point, and that was a precursor of some of the issues that were going to come up. But the government at that point was concerned, and the government I use in kind of a loose term, of whether or not they were convincing people that there were people that were too big to fail, and whether that was the right thing to have the markets believe that, don't worry, be with a big firm and the government will bail them out.
So one question I wanted to ask you about, it's not really in your domain, but I'm curious nonetheless what your view is. Chris Cox, chairman of the SEC, banned short sales on financial securities. It was a big deal.
Yep.
And I view that as really being the mark of when the bottom fell out. And, you were in the small circle of people that were in the discussions about what to do. And can you just now, 10 years later, let us know what happened?
Well, first thing is, that whether I remember things correctly or whatever. The issue of people have different views about the role that short sellers play. And there's also, I think, different views of short selling from Europe to the U.S. And I think there's also within the U.S. there's different views about how the capital markets function, right? And so I think a very simplistic view of short selling is that you're helping, the prices go down.
That's not the right view?
I don't think it is. I think, that my own view is I think that short sellers, that the whole ability to short has helped markets operate efficiently, and has helped on price discovery, and from my own perspective, if you ban, by the way, it was banning short selling only for financial companies, right? So you're just saying, this is, that's how fragile our thing is. You can't short, the following financial things. And in a way, you almost lead, the belief that actually they really are in trouble. But I think more importantly, you're affecting the markets in ways that you may not anticipate. And, so, it was not my area. And, I think if you asked Chairman Cox, I think he later on regretted the fact that they had done that. By the way, I would kid the then head of trading and markets, Eric Siri, about it. But that.
And what was Eric's view?
Eric would never.
Eric is a financial economist.
He would never be critical, if you would, of commission decisions. And I think there may well have been a view that it can't hurt to ban short selling, right? That why reward people who are driving down the value, if you would, of the institutions, and the very time the institutions are undergoing stress.
And then the next day, there was a line of black cars out front of the SEC building, and among those black cars were financial market participants that came in and said, for example, we can no longer enact our convertible bond arbitrage portfolio rebalancing because we can't short the securities, and therefore all the banks are
but I think that's true. I mean, unless you know all the different ways that people are utilizing a technique such as short selling, right? Just taking a very narrow view of it and saying that it's disadvantageous to the markets and we're just going to stop it, you then wind up with affecting all these other areas of the marketplace that you didn't intend to do that, but it wound up having that impact.
So let's move to an area that you know a lot about, money market funds.
Oh, yes.
They're very sensitive creatures in financial markets. They're kind of the canary in the coal mine, some might say, of market fragility. And during the crisis, they broke the buck. Can you tell us what that means, why it happened, and what the government did?
Sure. Money market funds, were obviously a creation of the mutual fund industry, and they, over the years, have evolved into an instrument where you have a constant dollar price, right? And you can write checks on them. You can, do a whole range of things, and
so like a bank account, but they have securities backing them.
Right, and on the other hand, though, they're always invested in, unless you have a treasury one, they're basically invested in financial instruments. Frequently, there would be, some CDs that you might own from a bank, but they also could be, very short-term instruments issued by IBM or some really good companies. And the construct for a money fund inside the SEC is that there's really a limitation, back then in terms of, what your average maturity could be, right? And so whether it was 90 days or 60 days, that was your average maturity, right? And, that was the constraint, that was there, that was intended really to limit what could happen to the dollar based on interest rate changes, right? More sophisticated, you might say now, why didn't you use duration or something? But it was intended to not have the dollar break, if you would, just based on interest rates rising, right? You had relatively short instruments that would be less sensitive to interest rate changes. So a couple things break the dollar, right? You could have, by the way, an instrument that you own that is either in default or in fear of default. It gets downgraded, right? Things of that nature. And all of a sudden, either you have to sell it at a loss or you're holding it not knowing whether or not you're going to wind up getting paid. Now, while you have the dollar, you still have to mark your portfolio to market every day. And then you have basically the market value of your portfolio. And basically, if your market value of your portfolio ever went to 99.5 cents, then basically you had to go to 99 cents, right? Because
so these are all assets that look money-like.
Right.
They look like they're a dollar until they're not a dollar.
And so there's a degree of exposure that's there for investors, right? that may not be truly appreciated by investors, right? Because of the dollar price. The dollar price, though, causes certain potential behaviors. Give you an example. Let's say that I own a share of a money market fund, and I know that they own a piece of paper that, is not as valuable as it was when they bought it. In other words, have unrealized loss in it, right? And let's say that their per share price was now at 0.9975, right? So not a threat that they're going to break the dollar. By the way, if half of the people in the fund redeem at $1, they're now at 0.995 and they will break the dollar, right? So the loss that I would have if I sat it out, right? The 9975 versus $1 is being visited on those guys who stay. So there's a prime mover advantage, right? So in effect, built into $1, right, is the risk, if you would, that if prime movers move, they get the dollar, and their losses are left for everybody else. And so it's a prime mover advantage. It also means even if I'm happy, I don't want to stay if you're leaving, right? So they call that, what do they call it? The prison's dilemma, right? And right, so what happens is once there's any frailty in the system, there's an incentive for people to get out, right? By the way, I can always go back in. What's the big deal? I'm not, give me my dollar, I'll go wind up doing. And so you wind up with, it's built in a way that once there's concern really about a particular money fund, there's an incentive for people to get out, right? And that's caused by the dollar.
Which fund broke the buck or broke the buck first?
Okay, well, let me before you get that, right? By the way, there have been funds that have broken the buck over the years, not many. But let's say you're, Merrill Lynch, and you have a money fund, and it's at 0.996, and it's about ready to get 0.995. You want to break the buck? No. You don't want that. Just think of what that's going to do to your brand, right? Besides, you probably get sued, right? Was really, that would have extraordinarily negative impact on Merrill Lynch, right? So during the financial crisis, you wound up with, firms that owned shares of companies where the market value was declining for a variety of reasons. Obviously not because interest rates were going up, but rather because, that they no longer had the financial health that they had before, right? And so what happened, and by the way, many of the instruments were, repo agreements with folks on financial side. Probably the biggest issue was purchases of repos, right, or money funds, right? And so you have a repurchase agreement from Bear Stearns. Oh, that's really good, right? Except that it was taken over by J.P. Morgan, so you didn't have to worry about it, right? But there were repo agreements with Lehman. There were repo agreements with Goldman. There were repo agreements with Merrill Lynch. So what happened as the financial crisis was evolving was that all of those came under pressure. And so I would wind up as division director getting these calls from firms that were sponsoring money market funds asking for no action position, which I just described, in order for them to guarantee that the fund would not break the buck, which came in different formats. Sometimes, can we buy that instrument out of the fund? We'll buy it at par, right? Or, how about we, we'll, guarantee that the price doesn't go below 0.9975, or, things of that nature. And you can imagine anything they could do where they didn't have to put capital was ultimately what they wanted to do. And so there were probably close to 20 no action letters that were given to firms. And there were a number of things that could cause it. I got a call from a guy that I knew from my Merrill days, who was one of the top executives for one of the foreign groups that had a huge money fund. And all of a sudden they had a redemption of 50%, right? So among other things, they really needed the ability to get liquidity into their fund. And so they needed relief from us. I knew they needed relief because I knew him. And once he called me and said, we have a problem, I said, yeah, you do. And so, before Lehman went under, right, enormous pressures were in the money fund industry, right? the benefit, I thought, was that the financial crisis hadn't really hit yet, and so firms were willing to write the checks to make the funds whole. And then you had Lehman, and Lehman was held by a large number of money funds, all of which but one were able to take Lehman out and make the fund whole. The one that couldn't was the reserve fund, and the reserve fund had Lehman, and that was a relatively large position for them, and did result in them breaking the dollar. And so they broke the dollar, but before they recognized that they broke the dollar, the run happened. As smart people, they knew they owned Lehman, get me out, right? And so a whole range of folks got a dollar, and by the time back then they couldn't shut down the fund until they called the SEC and got permission to shut down the fund. And they called, we gave them permission to shut down the fund. And at that point, over half the fund had left, because it had mainly institutional investors. And the value of a share was 97 cents, because that loss had been visited then on the remaining shareholders. It wound up working its way through eventually, but ultimately everybody got 99 cents, which is not a bad result when you think about that. But what was happening on Wall Street then during that period of time was that, because that didn't, I mean, when you think about it, reserve fund didn't end it, right? It just accelerated it. This was now we were in, because Lehman had far-reaching effects. Now what you had was, even if you had paper from Goldman Sachs, you weren't sure that the paper from Goldman Sachs was good, particularly because of swaps that happened on Wall Street. So you just didn't know, geez, what was the exposure of Goldman Sachs to Lehman?
Or to AIG.
And they have exposure to Morgan Stanley, but Morgan Stanley had exposures to Lehman. So you weren't, it's sometimes referred to as a daisy chain, right? In terms of what are the impacts of one of them breaking down, and then how does that work its way? And so, and I won't use firms, I'll use firms, but don't take these as being the real firms. It was like getting a call from Goldman Sachs saying, for our money funds, we want to guarantee the exposure of Morgan Stanley. And then a call from Morgan Stanley saying, Morgan Stanley, we want to guarantee, the impact, the effect of owning Goldman in our money funds, right? Now, those two, right, because you can only do that if you can't guarantee inside a money fund unless you are yourself top quality, right? So you look at it and saying, both of these can't be true. I mean, but that's what was going on in the marketplace. It was a relatively scary place. And what was happening then was that there was a real concern about the knock-on effects of the money funds into the general market, and for a couple of reasons. One was that money funds, because once the crisis hit, money funds were no longer buying commercial paper, right? It makes sense for a couple of reasons. One is that you weren't sure about the way you might end, but you also you wanted to shorten maturities, because you wanted to know that if you had a redemption request, you had the cash on hand. Right? So you go to overnight repos, you do a number of other types of, but you wouldn't go buy IBM's 90-day paper, right? So guess what was happening? This is my own view, right? So what was happening? IBM also had backup credit facilities with the banks, right? So when they couldn't get, they couldn't sell short-term commercial paper in the marketplace, they went to their backup lines of credit. They went to Bank of America and the biggest banks and say, fine, we're pulling down, $1 billion from, that's why we pay you for that backup line of credit. So now you had banks being hit by these things the very time they didn't want to, right? They always thought they could write these things, take in their fees, and never have to honor it, right? And so, all of a sudden, there's people saying, oh, this is, not good. Our banks are now being more exposed than they should be. What do we do about these, money market funds that are by the way, there's some folks who believe that the reason Lehman ran into such difficulty was that the money funds would not essentially renew their repos, right? And Wall Street lives on liquidity, and when all of a sudden they couldn't, continue to hold the securities they had based on using repos, then in a sense they had to start selling all those securities into the marketplace. So these things wind up being interconnected. So the next thing that happened was that Treasury wanted to do what was called the Treasury Temporary Guarantee Program. And we wound up, we actually put it together over a weekend. There were two of us from the SEC, a very knowledgeable outside lawyer to basically do the documentation. But we basically put together an insurance program for money funds over a weekend. And the industry ultimately paid about $1.2, I think, billion in premiums for that thing. It was backed by the Exchange Stabilization Fund that Treasury had that had, if I recall correctly, it was 40-something billion dollars was the entire amount backing. So it wasn't the government backing it. And by the way, it was a multi-trillion-dollar industry. So if you ever go look at the disclosures for the guarantee program that are in prospectuses for money
about
funds.
$4 trillion backed by a few billion?
Less than 50 billion, yeah. But we made that, we made the firms, it was voluntary for money funds to be in there, but they had to make the disclosure about what was really backing it and stuff. And so it really helped through the crisis. And what happened is the original redemptions that were coming in were institutional, and it was a general concern that it might wind up being retail, as time went on. And so it really stemmed, I thought, the redemptions that were occurring there. But it also pointed out some of the areas really of money funds that could use with some improvement.
So I'm going to fast forward a little bit. So we made it through the financial crisis. You saved the world.
Not me.
A few people.
By the way, one thing, when we were taking those calls, for firms that needed help, the woman who was taking the calls, Daya Blas, who's currently the division director of investment management, she was and there were only a couple of us inside the commission that really understood money funds and stuff. So she used to come running into my office and to Bob Dahl's and to Place's office and say, what do I do? And we'd tell her, and she'd go run back and tell people.
Which, by the way, she's still traumatized by that.
I don't think so.
So let's fast forward a little bit.
But the crises are running into my office.
Yeah. Money funds. So you left the SEC, you went to Goldman Sachs, and then like most people take one of the top jobs at the SEC, go back into industry, and right off into the sunset, but not you. You came back from Mary Jo White. Why?
A couple of reasons. One, I really enjoyed my experience at the commission. I really liked the mission. I really enjoyed working with the people there. It was a happy time. I would have stayed as division director, but my family was all back in New Jersey. My wife, my kids, my grandkids, and Dodd-Frank was passed in 2010, and so I looked at it and said if I wanted to do and get anything done that I wanted to get done, it was going to be on hold until the commission actually had the ability to clean up all the stuff that Dodd-Frank gave the commission over 100 rulemakings and studies that they had to do. And so my division bandwidth would have let us do things, but the commission bandwidth, would not have had room really to do non-essential required things. And so that's why I wound up leaving, and I lived down in Washington alone. And so, I'd go back to an empty apartment every night.
You came back as chief of staff.
But I came back for the following reason. So Mary Jo called me. Said, buddy, why don't you come down and be chief of staff? I said to Mary Jo, I said, I actually have no capabilities to be to be chief of staff. I don't have a skill set that you need. I don't know how to deal with Congress. I don't know how to deal with pressures that you're under. I said, I'm a substantive guy. I know law. I know, the investment management things. I kind of know how the markets work and stuff. But, I'm not sure I'd be much help to you. Mary Jo, to her credit, said, buddy, come on down. We'll have fun. So I said, okay. So I went down and we did have fun. It was, an incredible job.
So your career has spanned several decades in the asset management industry, and I think you're one of the few financial services professionals to really served at a high level, both in industry and government. It's a rarity to see both of that. Can you just tell us what you think the biggest changes have been in the asset management industry during that time in terms of practices, good, the bad, the ugly?
Yeah. I'll start off by telling you, in 1975, when I went into the industry, because I'm back and look, not that I remembered this, right? But there were less than 500 mutual funds, and their total assets were less than $50 billion, right? So I can name any number of mutual funds that currently exist where they themselves have more assets than the entire industry had back then. So that was the first point that I would make. The good and the bad. Back then when I first started in the industry, the firms were typically owned by the founder, someone who started out as an investor, who truly believed that what they were doing, they knew how to do it well, and they'd like to have funds that were successful or be successful for clients, and they put the name on the firm. I mean, that would be, or they would, they owned the firm, and so, and I'm not suggesting all of them were this way, but there were a lot of the folks who were extraordinarily successful that way. But to them, it was less about money and it was more about they loved what they were doing. They wanted to do that and wanted to do it well, and they wanted to provide a good service, if you would, to their investors. And I would say that industry was not yet institutionalized. And what's happened over time is that the entrepreneurial spirit and the ownership, really, of the investment firms, right, has been dominated now by the ones that are public companies owned by banks, a whole range of things, where it frequently, from my perspective, is such that it really is about how do we really monetize the capabilities that we have. It doesn't mean they don't want to make good products. It doesn't mean that they aren't trying to provide a good result really for investors coming in. But it's somewhat removed and is much bigger. And by way of example, the entire mutual fund industry now is 10,000 funds and probably $23 trillion of assets. It's huge, right? And there's a lot that goes with that. People have built up these kind of huge businesses. But I also think that the expectation for next year, if you wanted to know what rate of growth or whatever, to anticipate for your assets under management, it is, probably, if not negative, certainly isn't double digits, right? And there's, a fair amount of fee pressure as the markets have changed for those products. So you've had a lot of things that have been, forcing firms to have to deal with issues that when I started in the industry, while it might have been extremely competitive, it seemed like you had more time to get things done. And the culture of firms was different than it is today. And I think there's much more pressures, if you would, on people that are running the investment management firms now. And you just pick up the paper, you'll see that, why should I pay you to manage my money? You can't even outperform an index, right? So, a lot of pressures are there and a lot of desire really for financial advisors that are selecting just funds, if you would, that they would like to have low cost. And so the nature of how they're being used, the funds are being used has changed. On the investment advisory side, I mean, the advisors registered with the SEC manage over $80 trillion, right? It's a staggering number, right? When I started the industry, I didn't even know what $1 trillion was, and so for everybody here, it's a million. It's a lot of money, but and so you look at that and say, okay, how about some, the big firms, right? So you have, so I think BlackRock now has $7 trillion it manages. Right? Vanguard has over $5 trillion in mutual funds. One of the things you've seen over the last 10 years is that in the mutual fund industry, the assets have gone up. They're 3 times what they were, and yet the number of firms is down 30%. So you've had increasing competition inside the marketplace. And I think that in of itself is going to wind up being an issue. You see it being reflected when they talk about, if you take the top index funds, how much of the major companies they own. So you have 3 firms and they control 20% of major company. And I think, increasingly that, has people thinking about, is that a good result? You have folks that have that kind of economic power. So the markets have changed, and I think that, the role I think that people wind up playing, and I think I'm just extraordinarily fortunate that I grew up in a time where, true, I couldn't go find a lot of things on a computer because computers didn't exist except mainframes, but I had the ability to learn stuff over time, to learn over how the markets work over time. I joined Wall Street right after May Day. So I got to know and learn firsthand the impact that negotiated commissions had, right? And the rise of the discount brokers. Before May Day, discount brokers didn't exist. They couldn't, it was illegal. So you wound up with, the markets have changed, and I think in a lot of ways for better. I think the markets are much more efficient now than they were before, right? And the investment opportunity, I think, for folks in terms of choices they have, costs are down so considerably. A lot of really good things. And I'm not thinking back and saying, God, I love the way things were back then, as much as recognizing that there's enormous benefits that have come, and I've also recognized that in those changes, that there were changes also that occurred that I think were less advantageous. Both to the markets and to investors.
So I want to make sure the audience has some time to ask some questions. So we will in just a moment. If you have one, there's going to be a microphone that's going to pass around that we need you to use for the recording purposes. Before we do that, I just want to do lightning round. Can we do lightning round?
Sure.
Okay, so I'm going to ask you some questions, and you get 60 seconds or less to answer them.
Okay, fine.
So the SEC is a disclosure regulator. The Fed is a merit regulator. Can you briefly describe the difference between the two and whether you think that the SEC can survive as a transparency regulator?
Well, a merit regulator will frequently make a determination about whether something is good or bad, right? And the SEC is a disclosure regulator, which, it's the way it grew up, but the way that you start with the 33 Act, the way the regulatory. But I actually think it's wise saying, why should an Uber regulator know better than the markets would know? And so a disclosure regulator says, what we're going to do is tell the marketplace and investors all the information they need to make their own informed choice, right? And they make that, and at the same time give them remedies against people that made those disclosures in case those disclosures were fraudulent, right? Or material information was omitted or was not correct, right? So you think about it in 33 context, you come out with an IPO and the information is not totally correct, right? You wind up losing money, you go sue you sue the issuer, the underwriter, the directors, all the people that were responsible for the registration statement. So you have a remedy, right? Which, by the way, makes the market work well. And then you make sure there's secondary information out there so the markets function well. The regulator's never there saying, well, we don't think this is a good investor. No, this is not a good investment for people. We can't do that. Right? Okay, you can't do that. So let the markets decide is really what a disclosure regulator does.
So if you have good disclosure.
And by the way, and I'm sorry, go ahead. I was going to say, during the market crisis, there was a fair amount of criticism of the SEC for the fact that broker-dealers went under. The regulatory regime for broker-dealers was always premised on the fact that if broker-dealers went under, the customers were protected. It was never about protecting the brokerage business, right? In contrast, a banking regulator, who's a merit regulator, always has to worry, right? Why? Because there's FDIC insurance, and they want to make sure that the bank survives, right? And so the perspective from the SEC was on the brokerage firm's customers, right? Where the perspective really from the banking regulators is the health and safety of the banking industry. And so it's just a different perspective.
So it's if you have good disclosure, caveat emptor. Okay, so tell me about inverse and levered ETFs.
Well, they exist, right? So what does that tell you? It tells you that the SEC is about disclosure. They would, if you go, you can pull up the prospectus for an inverse ETF. Or
should retail investors be in these products?
Well, I have my own view, right? But they comply with the 40 Act, and therefore, when I was division director, they could register. Right? the issue for them was whether or not investors that were investing in them really appreciated some of the what I would say unique risks that they involved. The example is that for leveraged and inverse leveraged, those products, they don't work well in volatile times. So volatility kills their product. And, that is something that they wind up, the enhanced disclosure really in the prospectus about that. Not intuitive to an investor. And so where you do find the SEC walking in, it seems like they're a merit regulator, is that they go to brokers and to advisors that are recommending that people be in these and say, have you done enough of your due care in terms of making sure that you appreciate how they work and that the investor whom you're recommending it to appreciates how they work, right? And so it's less about the product and more, I would say, about making sure that the people who are giving advice to people investing in those are actually making them aware of the peculiar risks that are there.
I've got 67 more questions, but I don't have time to ask them. So does anybody have a question they want to ask Buddy?
You mentioned that there were the top 3 firms manage about 20% of the assets now. Do you consider that as good or a bad thing, considering the way that it's going? Because, I mean, as you said, fees are down, but that may lead to some monopolization.
I've watched all the different iterations of the industry over the years. And, the industry today, is not what the industry 5 years from now is going to look like. I worry about, the impact of a few firms having a large impact, and maybe not control, but a lot to say about, let's say, the allocation of credit. We're a capital markets economy, right? And so if you have, three firms that have the capability of deciding, whether or not a particular entity is going to be able to issue junk bonds, right? That may be, of concern to, the health of our economy on whether or not you want to have that concentration of power there. I think there's, advantages to having firms those size, particularly as they compete worldwide, right? They have the breadth to be able to be competitive worldwide in order to, to do things. So there are a lot of benefits. So it's not do I like them or not like them, as much as I recognize issues that wind up coming up because of, that particular thing. One of the things that winds up coming up, just think about it, right? You have firms that could own over 20% of a particular issuer, right? And so the question is, okay, how do they vote their proxies, right? By the way, they're not going to vote their proxies at times the way that some gadflies want you to vote them. They should be voting them based on what's best for their clients. But there'll be pressure in terms of disclosure about how they're voting, by way of example, such that people could put pressure on them, maybe change the way they vote. And so there's a number of side effects, I would say, that come from that. But I wouldn't say I necessarily think it's a good or a bad thing. But no. By the way, I also think it'll change. You think about it, somebody has $7 trillion of assets. What do you think under each of the areas they're competitive in that somebody can't pick them off? The great thing in the asset management business is you don't have to acquire a company to get the assets. All you have to do is outperform them. And the performance, will bring the assets to you.
Yeah, just a follow-up on that, the comment about the proxy voting.
Mm-hmm.
I think management has been skeptical of proxy advisors. So there you only have 2 proxy advisory firms.
Mm-hmm.
Do you think this consolidation under 3 very large asset management companies helps or hurts in the face of the concerns around 2 proxy advisory services?
I actually think that it probably raises some very similar issues. I'll give you my background on proxy advisory services. I mean, use them over time. Firms use them for different reasons. Advisors use them for different reasons. In many cases, you use them because they can easily facilitate you voting according to your proxy voting guidelines, right? So they're not telling you what to do, and you're not accepting what they would like you to do, what you're rather saying is, as proxies come in, they're coming into you. You might give me a recommendation. I actually don't care, right? But we will tell you how to vote, and you then execute on our behalf and vote, right? And then give us back the reports. The benefit from that is that they have the whole infrastructure for that, right? And the likelihood of you missing a proxy, goes down appreciably, right? So, a lot of efficiencies come from that. One of the difficulties that you run into is that when firms have proxy, their own guidelines, the bigger firms run into conflicts, where they own the security of, let's say, one of their top suppliers, right? Or, geez, they manage the pension fund for that company, right? Things that call into question whether or not they would vote their proxies, right, in the whether it's best for their client. And then frequently their procedures, well, when that risk, that conflict arises, that they will defer to how, let's say, ISS recommends the vote. And so some of the larger firms then wind up, on having to defer because of conflicts into how ISS or Glass Lewis, how they're recommending that you wind up voting. Why? Because the conflict is not there. Whether or not the way they want to vote is the right way is, in fact, the issue of proxy voting and those organizations. I'm aware that managers say, hey, look at these guys. They don't have any skin in the game, right? And all they're doing is telling you how they think. And by the way, sometimes it's based on wrong information, right? And people think that that's actually the way that you should vote because that's the way they recommend. And of the two, only one is registered as an investment advisor and the other isn't, right? So they don't even have a fiduciary duty with regard to the advice they're giving to you. And so you can look at that and say, is that is there a better system that might be out there? On the other hand, people voluntarily contract with them to do this for us. So I understand the frustration if you're a company and they're misinterpreting your information or characterizing it in a way you think is wrong. And I think the SEC is trying to, they've done 3 things in the last couple of years. I mean, they had a roundtable about the issues. They issued guidance to advisors about what they ought to be thinking about when they vote proxies and when they hire proxy advisory firms. And then they recently came out with proposed rule changes. So, we'll see. It's always been a contentious issue. I can almost predict how the commissioners will vote.
3-2?
Yeah, well, it doesn't wind up in an open meeting if it's 2-3.
That is true. Go ahead.
Mr. Donohue, I don't have the experience that you have, but I'm quite older than most of the people here, and I was working in wealth management over the last 25 years, and I'm managing money through the internet bubble and during the mortgage crisis and real estate bubble, and so we won't hold you to this, but is there anything that keeps you up at night? Is there anything that would, in your mind, be the next bubble? And could you foresee that if it?
I've always realized that I'm not going to predict the black swan event. That I'm not that smart. I'm not going to be able to do that. I do worry about things, and I worry about things I don't know. Right? Typically, if you have identified what a particular risk is, you can do something. In many cases, do something to protect yourself from that. Right? I do know there's some areas where I just think there may be market excesses that are going on now. Right? And so I am concerned about that. I also think that because of the way that the markets have grown, right, that the liquidity that's provided by dealers has gone down considerably. And most of the big brokerage firms, unlike the last financial crisis, now they're almost all banks. And so you wonder what the banking regulator will do to them if, in fact, they want to be the liquidity provider as the markets are going down. Or whether they're going to say, stop doing that. We don't want that risk to the banking system from you engaging in that. So, I have concerns on a number of areas. There's some products that I do worry about, but I also know that I'm not as smart as many are. I do risk when there's all these reports that come out about, the issues for liquidity of certain things in the marketplace, and what happens if kind of everybody wants to sell at the same time. And I say, well, that's probably always a problem, but I also recognize a huge amount of cash is on the sidelines, right? And so if the markets wind up, the liquidity providers are no longer the dealers. Right? Liquidity providers are other investors that have money on the sideline and that are waiting for opportunistic opportunities, that arise to put money into the marketplace. And so that gives me some degree of comfort. I'm not comforted by the fact that because of the extraordinarily low interest rates, that so much money is in the equity markets, and the multiples that are there are scary. So
You heard it here first.
Well,
it's recorded.
Well, but like I said, I'm not smart enough to predict this. But
So we have time for one more question to get us to the 60-minute mark. And
Great. The biggest growth in asset management has been in passive products like index funds and ETFs. What is your view on the growth, especially if you think about fund managers monitoring the companies, fund managers evaluating which companies are over or undervalued, as well potentially destabilization of financial markets if flows move into those indices, and that could potentially destabilize
No, I mean, it's a good
markets.
question. A couple of points I would make. Concern about index products is that it's not providing, it impedes the efficient working of the markets because there's no information in terms of the purchases or sale by them of securities other than the fact that they've had either money coming in or money going out, right? So, if everybody indexed, the markets would never change. The amount of money being there, you'd always, everybody would be correlated, right? Just because of what's driving it, right? If you only had one, an extreme example, if you only had one index and everybody put money into it, right? Then the markets that it owned, right, would be driven by, and pricing, whether or not buying and selling is happening on, whether or not money's going into those. I don't think they're not that size yet that they're going to have, but on the margin, they do impact. I mean, why is the stock going up? Well, because money's going into index funds, so they have to buy it, right, if it's in the index. So I do think, and you can see the effect of when something comes out of an index or goes into an index, market-wise, what winds up happening. So I don't give you any information in terms of, what people view of the health of a company when index funds are large holders, one way or the other. So that's one thing. Second thing is index funds, people say that people have gone passive. And I have a little bit of a different view. I think there's obviously some of that. But I think the funds have been used differently. And I started out when funds were a solution to somebody's financial needs. So it was the solution. I think if you go to a lot of the financial firms now, they are the alpha generators. They're not looking to the funds as the alpha generators. They're going to construct a portfolio. And when they're going to construct a portfolio, they're going to have exposures that they want to have. So if they want exposure to the S&P 500, they're going to want to have exposure to the S&P 500 that is relatively inexpensive to their clients. And in some cases that they can get in and out of relatively easily, right? And by the way, ETFs fill that bill big time. Index funds do, right? And so it makes sense to me if a large or small firm putting in a portfolio for a client that, okay, I want to have exposure to the broad market. Say, fine, buy an S&P 500, right? Index, low cost, and by the way, you're the one charging for putting this together, and you may have, but I want some active element. I put together different market exposures I want, and then I want to, and the alpha I'm adding is putting together that portfolio. So I think a lot of the use of index funds is for that purpose, whether they're ETFs or just index funds. And then the other thing is people look at this and say, okay, if you pick up any mutual fund prospectus, you can see whether or not they outperform the index, right? If you look at that and they haven't over time, it's saying, maybe I'll just buy the index if I know I want to be there. And so I think that is a real challenge for the active, part, and by the way, during a bull market, I think historically active management, particularly where there isn't a lot of volatility, active management has difficulty in outperforming. Particularly if the active management is in the, the value space. But that's, so I'm sorry, I hope that answered the question. But
So Buddy, thank you for sharing your time with us today and for the audience questions, and good luck to you going forward.
happy to do
Thanks.
it. Thank you.